Good day, everyone. Today, we will discuss the Income Tax Transfer Pricing Regulations 2018 issued by Nigeria's Federal Inland Revenue Service (FIRS). These regulations mark a significant update in Nigeria's tax framework, replacing the previous 2012 transfer pricing regulations and align Nigeria with global best practices in transfer pricing. So we're looking at the overview of the Nigerian transfer pricing regulations. Effective from 12 March 2018, these new regulations incorporate key provisions from the 2017 OECD transfer pricing guidelines and the United Nations Practical Manual on Transfer Pricing for Developing Countries. Their primary objective is to address base erosion and profit shifting BEPS concerns, ensuring that multinational enterprises comply with the arm's length principle while introducing tougher penalties for non-compliance. So we will delve deep into the key updates, compliance obligations, and implications of these regulations, providing a clear understanding of how they impact businesses operating in Nigeria. So let's look at it. We'll start with the purpose of the 2018 regulations. The 2018 regulations broaden their scope to include additional tax laws. So aside the initial Personal Income Tax Act, Companies Income Tax Act, Petroleum Profit Tax Act, there's an additional addition. There is an additional tax law which has been included, which include Capital Gain Tax Act and Value Added Tax Act. So these new additions complement the tax laws covered under the previous regulations. Now, this expanded framework enhances Nigeria's ability to monitor transfer pricing activities across various sectors, ensuring a more robust compliance landscape for both local and international entities. Under the covered persons, a key change introduced by the 2018 regulations is the replacement of the term connected taxable persons with connected persons. So this broader definition includes entities connected through either the local legislation such as Personal Income Tax Act, Company Income Tax Act, Petroleum Profit Tax Act, Capital Gain Tax Act, or the Value Added Tax Act, or through international standards, including the OECD Model Tax Convention and double taxation agreements between Nigeria and other jurisdictions. So, this wider scope ensures that any business relationships with related parties, whether local or cross border, are properly captured under the regulations. Now, under the statistical measures of arm's length pricing, one of the critical advancements in the 2018 regulation is the formal recognition of the interquartile range as the appropriate measure for determining arm's length pricing. By applying this global accepted standard, the FIRS ensures that the comparability of transactions between related parties is fair and reliable, minimizing the risk of manipulative pricing. Custom valuations too. Under the new rules, custom valuation prices will no longer automatically be accepted as arm's length prices for transfer pricing purposes. The Federal Inland Revenue Service reserves the right to review and adjust these valuations. This separation between customs and tax valuations will ensure that pricing for transfer pricing purposes is independently scrutinized and aligned with Nigeria's tax regulation. Now, commodity transaction. Commodity transaction. For the first time, the 2018 regulation introduced specific guidelines for pricing commodity transactions between related parties. The regulations stipulate that the transfer prices for import and export of commodities must be based on quoted market prices unless valid reasons for adjustment are provided. So these provisions also adds transparency to commodity-based transactions, reducing the opportunity for profit shifting through manipulated pricing strategies. On intragroup services, the 2018 regulation also introduced a benefit test to justify the pricing of intragroup services. Companies must demonstrate that the services provided by related entities were beneficial to the recipient and were indeed rendered. Furthermore, costs related to shareholders' activities must be excluded when pricing these services, ensuring that only actual service-related expenses are accounted for. Now, on transactions involving intangibles, new detailed guidelines provide clarity on the pricing of transactions involving intangibles such as intellectual property. The regulations emphasize the importance of the development, enhancement, maintenance, protection, and exploitation DEMPE functions when assessing the arm's length pricing of intangibles. Furthermore, tax-deductible payment for intangibles such as royalties are now capped at 5% of EBITDA, which could significantly affect the tax liabilities of companies heavily involved in intangible transactions. Entities that hold significant capital but do not control the financial risk associated with their activities are now restricted to risk-free returns under the new regulations. This ensures that profit or losses linked to actual risk-taking activities are allocated to the entities that manage and bear those risks. With respect to annual filing requirement and documentation, the new regulation require companies to file transfer pricing declaration and disclosure forms annually. These forms must be submitted in accordance with the company's incorporation date or financial year end and must be updated in cases of mergers, acquisition, or other structural changes. Failure to meet this requirement can result in significant penalties that we will look into later. The 2018 regulations emphasizes the need for comprehensive master files and local files as recommended under the OECD BEPS Action 13. These documents must be contemporaneous and submitted to the Federal Inland Revenue Service within 21 days upon request, ensuring that companies are maintaining accurate records of their intercompany transactions. Now, this regulation also talk about the materiality threshold. For companies with intercompany transactions below 300 million naira, contemporaneous transfer pricing documentation is not mandatory. However, these companies must still prepare and submit documentation within 90 days upon receiving a notice from the Federal Inland Revenue Service. Now, let's look at the penalties, safe harbor, and dispute resolution. We are still looking at all these based on the overview of the Nigerian Transfer Pricing Regulations 2018. Now, the 2018 regulations introduced stringent penalties for non-compliance, including 10 million naira for failure to file a TP declaration, with an additional 10,000 naira for each day the default continues, 25,000 naira for each day that companies fail to notify the FIRS of changes in directors. So higher penalties for incorrect disclosure or failure to submit transfer pricing documentation upon request. These penalties underlines the importance of timely and accurate compliance with transfer pricing regulations. With respect to the safe harbor provisions, the previous safe harbor provisions have been removed. However, the Federal Inland Revenue Service may issue specific safe harbor guidelines on a case-by-case basis. This flexibility will provide relief to businesses that qualify for safe harbor under specific circumstances. With respect to dispute resolution, the 2018 regulation also revised the dispute resolution process, allowing the FIRS Transfer Pricing Division to refer disputes to a dispute resolution panel. The panel membership has increased from 3 to 5 members, including a representative from the Federal Inland Revenue Service Legal Department, ensuring a broader review of transfer pricing disputes. So, the implication of all this now is that we have stronger penalties and enforcement. So the tougher penalties signal a stricter enforcement environment. Companies must ensure timely and accurate filing of their returns and declarations to avoid hefty penalties. Then increased documentation burden too. Large multinational corporations will face increased documentation requirements, particularly with the introduction of master file and local file concepts. Companies must maintain contemporaneous documentation to meet compliance requirements. Now, with respect to risks of tax dispute, the introduction of specific guidelines for commodity transactions and custom valuation will likely result in heightened scrutiny from the Federal Inland Revenue Service. So, companies engaged in cross-border trade should be prepared for potential disputes. Now, proactive risk management. Companies must proactively conduct internal reviews to identify any potential gaps in their transfer pricing compliance. Failure to manage that will result to transfer pricing risks. And with respect to deductible payment for intangibles, the 5% EBITDA cap on tax deductible payment for intangibles may impact companies with low profit margins or those that are loss making. So companies must assess how this cap will affect their tax liability and adjust accordingly. So now we've looked at the overview of the 2018 regulations. So now we've also looked at the key concept. We've looked at the key concept, which is the arm's length principle, that all transactions between related parties must be conducted at arm's length. We've also talked about the detailed documentation requirement to support the the pricing of intercompany transactions, which include both the master file and the local file. Now, the income tax transfer pricing 2018, which revised the initial 2012 regulation to incorporate recent development and international best practices, it emphasizes the alignment of transfer pricing outcome with value creation and provide detailed guidelines on compliance. And if you're looking at, the arm's length principle, all transactions between related parties must be conducted at arm's length. Detailed documentation requirement to support pricing of intercompany transactions. And then looking at the transfer pricing method, acceptance of 5 transfer pricing methods, including the comparable uncontrolled price method, COP, resale price method, which is RPM, cost plus method, transactional net margin method, and profit split method. And taxpayers are also required to file annual tax return, which we have mentioned earlier. There's also provision for taxpayers to enter into the advanced pricing agreement with FRS to obtain certainty on transfer pricing matters. So the role of the relevant tax authority, the Federal Inland Revenue Service is the regulatory authority responsible for the administration, assessment, and collection of taxes in Nigeria, including transfer pricing regulations. And they ensure that FRS ensures compliance through audits, review, and the issuance of guidelines and directive. So let us look at the functions. Guidance and clarification, they do that by issuing guidelines and providing clarification on transfer pricing regulation, either via public notices or through the FRS circular. Audit and review, they conduct transfer pricing audits to ensure compliance and identify non-compliance. We've also mentioned the penalties that are applicable on this when I was explaining the overview of transfer pricing regulation 2018. Now, the APA, which is the advanced pricing agreement, so facilitating the application and approval of APA to provide certainty to taxpayer is also one of their key functions. Dispute resolution, I've explained that under the overview of transfer pricing regulation. So handling disputes arising from transfer pricing assessment and adjustment. So let's look at the documentation requirements. I've mentioned that too: local file, the master file, and the country by country reporting. And the local file has to do with the detailed documentation on the taxpayer's business for intercompany transactions and transfer pricing analysis. For the master file, comprehensive this includes comprehensive documentation providing an overview of the multinational enterprises group global operation. So the master file, encompasses all the group operations, an overview of all the group operations, business operation, including organizational structure and their financial information. Country by country reporting, that one is talking about the allocation of income, taxes paid, and business activities by tax jurisdiction for large multinational enterprises. So we've also looked at the transfer pricing methods. I've explained transfer pricing method, the COP method, which talk about the comparing the price of a controlled transaction with the price of a comparable uncontrolled transactions. Now for resale price method, determine the resale price margin earned by the reseller, applying a markup on the cost incurred. This is talking about the supplier now with respect to the cost plus method. I'm sure each of these we will still discuss all this in details. All this method we'll still discuss all this in details in another module for our understanding. Here we are focusing more on the overview of transfer pricing regulations and the key requirements. So we'll go into that in details. Transfer pricing returns must be filed annually. That has been explained. All the disclosures forms, declaration forms, which have also been explained under the overview of transfer pricing, 2018. That's the overview of the transfer pricing regulation 2018. So now let's look at some case study. We've talked about the compliance requirements and deadlines, annual returns, documentation submission, failure to comply. That has also been looked at. We've talked about the penalties that are involved under the overview. So let's go to the case study now. A Nigerian manufacturing company. So a Nigerian manufacturing company, XYZ, that engage in significant intercompany transaction with a subsidiary in Ghana. Now, FRS conducted a transfer pricing audit to verify compliance with the 2018 regulations, and the issues that were identified is documentation gaps. So XYZ Limited failed to maintain comprehensive transfer pricing documentation. And let's look at this. So the issue that has been identified is documentation gap, the non-compliance with the methods, which is the second issue that was identified. The company did not apply the appropriate transfer pricing methods to determine the arm's length price, and the consequences are penalties. These are some of the penalties that we've explained earlier. XYZ Manufacturing Limited was penalized for failure to maintain adequate documentation for inaccuracies in its transfer pricing returns. FRS also adjusted the transfer prices, resulting in additional taxes and interest. So it is important that we look at the key takeaways now. Importance of documentation. Documentation is very, very important. Maintaining detailed and accurate documentation is crucial for compliance. And then proper application of method. Companies must also apply the appropriate transfer pricing method to justify their pricing policies. And proactive engagement, regular engagement with Federal Inland Revenue Service and seeking guidance on compliance can help avoid penalties and ensure adherence to regulation. So to just conclude, in conclusion, the 2018 transfer pricing regulations provide a comprehensive update to Nigeria's transfer pricing framework, align it with global standards. So these changes offer businesses an opportunity to enhance their compliance processes and align their transfer pricing policies with international best practices. However, the stricter penalties, documentation requirements, and increased scrutiny require companies to adopt a proactive approach to managing their transfer pricing risk. This includes maintaining robust documentation, ensuring accurate filing, and conducting regular internal audits to avoid penalties. The regular internal audit here is to always do probably a transfer pricing health check to check your status and to know the status of your compliance in-house. So as Nigeria tax environment continues to evolve, businesses must remain vigilant to ensure full compliance with these regulations, protecting themselves from significant penalties and ensuring smooth operation with regulatory framework. Thank you for your attention.